The last class was about payback period when annual cash inflows were equal. Next, we'll see the payback period when annual cash inflows are unequal. In this situation, we have to use this formula E plus B by C, where E is equal to the number of years preceding the year of final recovery. B is balance amount still to be recovered, and C is the cash flow during the year the final recovery is made. Okay, we shall better understand this situation with a problem. Look at this example. The cost of the project is rupees 1 lakh and the cash inflows in the first year is rupees 10,000, second year it is 15,000, third year it is 25,000, fourth and fifth year it is rupees 30,000 each. We have to calculate the payback period. We can see that the cash inflows are unequal. You're not getting the same amount each year. So to recover this original investment of rupees 1 lakh, it is about 4 years and 8 months. How do we calculate that? Add the years in which we get complete part of the investment. That is first year 10,000 plus second year 15,000, which is equal to 25,000, plus third year 25,000 gives you 50,000, plus fourth year 30,000 gives you 80,000. And you have a remaining 20,000 to get, so that you're able to cover rupees 1 lakh. Okay, so here B, the balance amount is 20,000, and the cash flow during that year in which we have to cover up this 20,000, that is the fifth year, is 30,000. So B by C is equal to 2 by 3 years. And when you have to convert it into months, you have to multiply it with 12. You have to multiply it with 12 to convert years to months. So 2 by 3 years is equal to 8 months. Therefore, the total time to get back the initial investment is E plus B by C, which is equal to 4 plus 2 by 3, or 4 years and 8 months. So we use this formula, right? Payback period is equal to year before full recovery. Here it was 4 plus unrecovered amount, balance amount 20,000. Here it was 20,000 divided by cash flows during the year. Here it was 30,000, and that's how we got 4 years and 8 months. Here you can see a note. Under payback method, the cash inflow or benefit or return means the operating profit before depreciation and amortization of intangible assets but after tax. Yeah, usually we charge depreciation on tangible assets and amortization on intangible assets, right? So you might have seen the acronym CFAT, okay, or you might come across it later in this chapter. CFAT is cash flows after tax. We earlier learned the concept that depreciation is a non-cash expense, but it is a deductible expense from profit. So when we charge this expense to the profits are reduced. Simultaneously, the tax to be paid is also less, right? So that means you're making a tax saving, right? There is no actual cash flow outflow, but you have to pay less tax because depreciation can be deducted from profit. So you're making a saving on tax, and that is called as depreciation tax shield, the saving that you make on tax. Now, since depreciation is a non-cash expense and there is no actual cash outflow, while calculating the cash inflows, we first calculate the tax, deduct it, and then add back the depreciation. So usually when we see cash inflows in this chapter, in this capital budgeting chapter, it is the cash flow after deducting tax before depreciation. That means you add back the depreciation. Now, in this payback method, how do you take a decision rule or selection criteria? The shorter the payback period, the better the project. This means a project having shorter payback period is chosen, right? You need the investment, you need to cover up the investment as early as possible. So you will choose that project which has lesser payback period. Next, we'll see the advantages of payback period. Usually, as we say, it is simple and easy to understand. It is very important for cash forecasting, budgeting, and cash flow analysis, right? You need to know how fast you will be able to recover the investment amount, whether it will take a long period. If it takes a long period, when you forecast and you see that it will take a long period, you might not go for that project. Okay. Then this method can be used profitably for short-term capital projects which start yielding returns in the initial years. So you want investment to be covered as soon as possible. So that can be done only in short-term capital projects. If it's an infrastructure project, it will take a lot of time for you to, get back the investment. It minimizes the losses through obsolescence, the possibility of losses through obsolescence. Because here we choose a project which has a payback period which is lesser, right? So, the losses because of product being out of date is less, because we're going to take up a project with less payback period. So you're going to cover up the investment as fast as possible. That is before the project or the product could become obsolete. The next is it takes into account liquidity, because here we are trying to take up short-term investments with, which are more or less liquid. Okay, you're able to get the inflows as fast as possible. So we're going to take into account more liquid projects. So it takes into account liquidity. This method can also be used for projects with high uncertainty. We're trying to at least cover up the investment amount. So there's a lot of uncertainty about the returns. But here we at least trying to take up the project which helps you to cover the investment amount as quickly as possible. So that part of uncertainty is being reduced. Next is the disadvantages of payback period. It ignores time value of money. It ignores the concept that today's 1 rupee is more worth than tomorrow's 1 rupee. So it ignores the concept of time value of money. It completely ignores cash inflows after the payback period. That is another limitation. That is, we only consider whether the project is being able to cover up the investment. We are not bothered about the cash inflows after the payback period. Third, it does not measure profitability of projects. It focuses only on liquidity, means capital recovery. So that is what we told earlier. We are not considering whether there is a good return after this payback period. So we do not measure the profitability of projects. Next, it does not measure the rate of return. Again, we are not measuring the rate of return, and there are other methods to overcome these limitations. We have the post payback profitability method to measure the profitability, which we'll learn next. And then next we have a average rate of return method to measure the rate of return. But in payback method, we're only bothered about how fast we're able to cover up the investment. It does not consider the magnitude and timing of cash inflows. As we told earlier, time value of money is not considered, and the magnitude of profitability or returns is not being considered. It ignores cost of capital. Cost of capital is the chapter which we're going to learn next, and cost of capital is actually the rate of return itself. Okay, so we'll learn about cost of capital in detail. The literary meaning, if you look at cost of capital, is what? the cost on capital, if you just say it in that way, though cost of capital is actually the rate of return, here it is cost of capital means the interest rate you have to pay on loans, or the dividend amount which you have to pay on shares. So that is actually the cost of capital. So such factors are not being considered here. That means here time value of money is not at all being considered. It's the most important thing. And the profitability of the projects after the payback period is also not being considered. These are two major things which are being ignored in payback method.